Hello and a very warm welcome. Today, we're diving into what I think is a real game changer in the new Income Tax Act of 2025. We're talking about Section 46. Look, if you're involved in any kind of capital-intensive project, this section provides a tax incentive that you absolutely have to understand. So let's break it all down.
Just imagine this for a second. You're about to pour crores into a brand new warehousing facility, or maybe a hospital. Now, what if the tax law said, go ahead, and you can deduct the entire capital expenditure, the building, the machinery, all of it, in the very first year of operations? Well, that's not just a nice thought, that is the core promise of Section 46. So here's our game plan for the next few minutes. We'll start with the big picture of Section 46, then we'll really unpack that 100% deduction, we'll look at the critical conditions and what's excluded, walk through a practical example, cover the compliance side of things, and then wrap up with the key takeaways.
All right, let's jump right in. First up, the big picture. To really get a handle on Section 46, we need to see where it comes from and where it fits in the new tax law.
Now, for you seasoned professionals out there, Section 46 is probably going to feel pretty familiar. And that's because it's the direct successor to the old Section 35 AD from the 1961 Act. The best part? The core benefit is exactly the same. A full 100% deduction on capital expenditure for certain businesses. The goal is also the same, to really drive investment into priority sectors. So, think of it this way. The name has changed, but that powerful incentive is still very much alive and kicking.
Okay, so let's get into the good stuff. Let's unpack that 100% deduction. What does it actually mean for a business, and who gets to take advantage of this fantastic benefit? I mean, the number really says it all, doesn't it? 100%. This is a complete write-off of your eligible capital costs, all in a single year. Now, this is totally different from depreciation, which spreads that deduction out over many years. Section 46 lets you recover your investment costs immediately, up front, and that can have a massive, and I mean massive, positive impact on your cash flow.
But, and this is a big but, this benefit isn't for just anyone. It's specifically targeted at what the Act, in subsection 11, calls specified businesses. We're talking about key infrastructure areas. Things like setting up a cold chain facility, warehousing for agricultural produce, building a hospital with at least 100 beds, affordable housing projects, or even warehousing for sugar. The list is very, very specific, so your first job is always to check if your new business venture actually qualifies.
A question I get all the time is about those expenses that happen before you even open your doors. What about the cost of building the place or buying the machines before you're officially in business? Well, Section 46, subsection 2 is super clear on this. It says any capital expenditure you incur before you start operations can still be claimed for the 100% deduction. You just claim it in the very first year your business starts, as long as you've capitalized it in your books of account.
Right. Now, an incentive this powerful, well, it naturally comes with some pretty strict rules. To claim this amazing deduction, you absolutely have to play by the book. So let's look at the key conditions and, just as importantly, what's explicitly excluded.
Okay, so Section 46, subsection 3 lays down two really fundamental conditions. First, the business has to be genuinely new. You can't just split up or reshuffle an old business and call it new. Second, the plant and machinery have to be new as well, not just transferred from another business. The law does give you a little bit of wiggle room here, though. It allows up to 20% of the total value of your machinery to be secondhand.
It's also super important to know what's not covered. The 100% deduction has some very specific things it doesn't apply to. For example, the cost of buying land is completely out. Same goes for any money spent on goodwill or financial instruments. And here's a key compliance tip. If you pay more than 10,000 rupees in cash for any asset, that expense is disqualified from this deduction. So keep that in mind.
Now, this next point is probably the most critical one to remember. When you claim a deduction under Section 46, you're not just getting a tax break, you're making an 8-year commitment. According to subsection 9, any asset you've claimed this deduction on must be used exclusively for that specified business for 8 full years. The idea here is to make sure the incentive is for genuine long-term investment, not just some short-term tax trick. And if you sell that asset or use it for something else within that lock-in period, guess what? The tax benefit gets clawed back.
Okay, that's enough of the theory. It's one thing to talk about the law, but let's see how this all comes together in the real world with a simple, practical example. So let's imagine a company is setting up a new warehouse for agricultural produce. Their total project cost comes to 1.5 crores. Right off the bat, we know the 50 lakhs they spent on land is ineligible.
But the 70 lakhs for constructing the building and the 30 lakhs for brand new machinery? Both are eligible. So what does that mean? It means out of a 1.5 crore project, this company gets to deduct a full 1 crore from its business income in the very first year. That's huge.
Claiming this deduction isn't just about being eligible. It requires meticulous compliance. Getting the procedure right is absolutely non-negotiable, and it's really important to know the common mistakes that can get your claim thrown out. Let's quickly run through a compliance checklist. First, you have to maintain a separate set of books for this specified business. You need to clearly wall it off. Second, as per Rule 66 of the new tax rules, these accounts must be audited by a CA. That audit report, which is your proof, needs to be submitted in Form 32 by the due date. And finally, a really important point from subsection 5, if you take this 100% deduction, you can't claim any other deduction, like normal depreciation, on that same asset, ever. It's an either-or choice. You can't have both.
So this brings us right to the biggest pitfall, the elephant in the room. What happens if you break that 8-year lock-in rule? What are the actual real-world financial consequences? Well, the consequence is severe. The tax benefit gets completely reversed. Under Section 46, subsection 9b, the entire deduction you originally claimed, minus what you would have gotten from normal depreciation over the years, is added back and treated as your business income in the year you broke the rule. So in short, you end up paying tax on a benefit you might have gotten years ago. It's a serious penalty. Wow, we've covered a lot of ground, haven't we? So let's take a moment and just boil it all down to the most important points you need to remember about Section 46. Okay, to sum it all up, Section 46 is a massive incentive, but it's highly targeted and excludes certain costs. That 8-year lock-in is a serious long-term commitment. It demands strict, mandatory compliance, no shortcuts. And finally, always remember that the consequences for breaking those rules are pretty significant.
So, as you start planning your next big capital investment, the question you should be asking yourself is, could this project be a specified business? A really careful look at Section 46 could be the key to unlocking major savings and improving the financial viability of your project right from day one.
Thank you so much for watching. If you found this explainer helpful, please do me a favor and like, subscribe, and share it with your colleagues and friends. Just a reminder, this video is for educational purposes only and is not professional advice. Tax laws change, so please consult your professional advisor before taking any action. This is an AI-generated educational video.